Hello YouTube and welcome to WhatDaMath. This is yet another video on InvestoMATH, or how to invest better using mathematics. Now in this video we're going to be talking about gold. This is gold, and basically the question is this: is gold a good investment? So what I'm going to do today is talk about the good stuff about gold. I'm also going to mention some bad things about gold. And then finally we're going to come up with some sort of a conclusion. Should you buy gold? Is it a good investment? And do you want it? Specifically, I mean, do you want this in your portfolio? Because obviously you want gold. Everybody wants gold, right? Right? And the first question I'm going to answer, and I guess that's the question you should be asking yourself, is why should I buy gold? So why do I need this stuff? I mean, obviously it's nice and shiny and all, but why? And from a mathematical perspective, or I guess from financial perspective, the first answer is that it's actually accepted everywhere. And I really mean everywhere. Unlike Visa and MasterCard, which is supposedly accepted everywhere, but it's not really true. This stuff, you can basically go anywhere in the world and someone will want to buy it from you, or you can basically trade it for something. So in that sense, it's very, very universal, and I think this is the key here. It's very universal. It's a universal currency. The second reason why people usually talk about buying gold is because it's supposed to represent safety and stability. Now, is it really safe? Well, we're going to discuss this in a few seconds when I show you graphs and maths and stuff. But basically, that's one of the reasons given usually. Safety, and because this is a very stable currency. The reason number 3 is that it has an increased demand, especially in the last few years. And that's mostly because we started to produce a lot of electronics using gold. It's also used as a kind of a conductor because it's has a very high conductivity. It's also highly in demand in India, where it's used as jewelry, and of course many countries such as, for example, Russia and China started buying gold as a kind of a, once again, stability currency. Basically, they started buying a lot of these gold bars that you see right here to stabilize their own currency. So yes, there is a bit of an increased demand, at least so it seems. Alright, so that's reason number 3. Let's look at another one. And the reason number 4 is that there's a reduced production of gold. In the last few years, or I guess in the last decade or so, the production of gold actually has decreased. There's less gold being produced every year. And this, of course, creates the whole supply and demand thing where, you know, you have not so much supply, so supply has decreased, and you're getting a little bit more demand. So this is kind of, you know, economics 101. You should be kind of buying gold, right? But don't rush yet. Don't go yet. Don't go and buy gold yet. We still have some math to do. I'm gonna explain things to you. Okay? So just wait and watch the video. The other thing about gold is that over the last few centuries, or I guess actually you could say even thousands of years, only about 20 cubic meters of gold has actually been mined. So it's not that much. If you were to take gold and you melt all of the gold in the world, and you would then try to fill Olympic-sized pool, which is, if you know, it's about 50 meters by about 20 meters by I don't know how many meters, but basically this is an Olympic-sized pool. The total amount of gold would be actually approximately 3.3 of these pools. So in other words, there isn't that much of it. 20 by 20 by 20 is really not that big of a cube. So if I were to make a cube, and this is geometry 101, you're basically looking at something that is the size of a small building. So this is 20 meters, and also 20 meters. And this is how much gold in total there is in the world right now. Obviously, there's more, you know, that hasn't been mined yet, but it's going to be a while before it increases. And when it comes to investments, one of the biggest things that people usually talk about is that it actually reduces the risk of your portfolio. Usually they say, if you're a good investor and if you want stability, you should invest as much gold as you can, or get as much gold as you can. If you're more risky, get a little bit of gold, but you should always have gold in your portfolio. Now, once again, this is, I think it's a speculation. I'm going to get to that in a second. But yes, it's supposed to reduce the risk of your portfolio as well. There's another reason actually, and one of these other reasons is that 20% of the entire gold reserve actually belongs to central banks in different countries. Like, for example, Bank of England and Bank of Canada, they have a lot of gold stored inside. In other words, they usually use this to kind of stabilize the currency. So if the currency becomes unstable, they may either buy or sell gold just to stabilize it. So it does give the gold a kind of a standard because, you know, a lot of countries have them stored in their banks. It does give gold a little bit of, I guess you could use the word value. And obviously, that's not something we're questioning. The gold does have value, but this makes it a little bit more official. one more reason is that gold actually gets a special treatment from tax in many different countries. Like for example, in European Union, there is no sales tax on gold, and in US, if you are selling gold, you actually get a lot less tax than if you were selling property or equities. And that's of course stocks. Now that's kind of important, but once again we're gonna get to that, and this is one of those reasons where of course it makes more sense to buy gold, because in some countries there is a tax shelter, but at the same time, is it really going to be worth it? Alright, so now let's get a little bit more negative and talk about why you really shouldn't buy gold. So let's start with reason number one. And reason number one is really simple. Gold really has no kind of yield. It doesn't provide any dividends, and it doesn't provide any interest. So basically, if you buy gold, it just kind of, it's a gold bar and just gonna lie there and do nothing. It's just gonna stare at you. And obviously some people want that because they want stability. But if you're a young investor, or if you're an investor that tries to raise his or her capital, basically you want to get more money, which is kind of what this is all about. If you want more money, then unfortunately, this is probably not the best investment for you. Another obvious reason is that gold is kind of hard to keep safe. I mean, it's easy to steal. If that gold bar is lying around and staring at you, someone can just come and take it from you. And so theft and stealing and so on it can be a challenge here. And so basically, yeah, it's hard to keep safe. You need to have a safety deposit box. It has to be very secure. And if you have a lot of gold stored, then you really need to get some kind of a private security going. But obviously that's not the biggest reason. Let's actually talk about the next reason, which is a little bit better than that. And the reason I wanted to talk about is this: questionable growth. What does that mean? Well, growth means, how fast something gains value. And for gold, it's very questionable. I'm going to show you a graph right now that kind of gives you an idea of what I mean. And let's start with this graph right here. So this is a price of gold from 1970 to 2008. I'm going to show you another one that's a little bit more recent, but that's just to give you an idea. So right here, we're going to start with the 70s, where the gold was about, I don't know, $40. And in 2008, by the end of 2008, it was about $900. Now, you can see a trend here. So it was kind of slowly increasing here. Then it was, it fell to almost the same value here. Then suddenly it exploded. Now, this is actually known as a kind of a second gold rush in a sense, because in the 80s, gold has dramatically increased in price. It's in fact much higher than it is right now. Even though you can't really see it here, it actually fell down. So it's not even as expensive as it used to be in the 80s. And there's many reasons for why it actually went up so high in the 80s, but really it was all about world instability. And specifically when I say instability, what happened was, this is when the Soviets, the USSR, invaded Afghanistan. So this invasion actually almost caused the Third World War in a sense, because communism was at its peak, the world was, panicking, and a lot of people were basically storing up gold and thinking that, if anything happens to the US, at least I have some gold to store and I can maybe possibly use that to survive. But as you can see, this didn't last long, and gold just crashed afterwards. It went down to almost $300 from almost $900. So it's basically lost about a third of its value. And if you look here, it actually happened quite a lot. It goes up and it goes down, it goes up, it goes down, it goes up, it goes down, it goes up, and it goes down. Then right here we have the 2008 crash. This is when it went up, and I'm about to show you the next graph, and you'll see that it's actually going to go down. And so here's the more recent graph. So you can see the gold after 2008 crash kind of went up, but then it started going down again, and it still keeps going on. For the past 2 or 3 years, it actually has been falling. And the thing is, it's not just gold. Oh, and you can see the value here is actually lower than it was in the 80s. It's not just gold. It's actually a lot of different commodities, specifically precious metals and things like oil. So here's, for example, a graph that shows you how diamonds performed. So once again, in the 80s, they went up, but for the rest of the time until pretty much now, or I guess 2010, diamonds haven't actually increased in value at all. So diamonds are even worse in terms of investment compared to even gold. Here's a similar graph for silver. So you can see for silver, once again, in the 80s, people panicked, they started buying stuff, but the World War III never occurred, so they started selling it, and it went dramatically down, stayed down for quite a while. In 2008-ish, people started panicking again, and then they started selling it again. So you can see a trend. Whenever people panic, they think gold and silver and other precious metals or precious commodities will actually save them, so they start buying that stuff. And then when people realize nothing's going to happen, they start selling it and it loses value again. Well, you may say, well, listen, isn't everything kind of like that? Well, possibly, but we'll talk about this in a second. Let's actually keep talking about why you should not buy gold. And the next reason is this. The reason why the price varies so much is really not because, gold has some kind of intrinsic value. It's really because of speculation, just like with stocks. And of course, because sometimes people want to buy gold. Like, for example, there's a lot of commercials that promote jewelry and stuff like that. Or because, something happens, people panic, they think gold will save them. They actually think that this will be their savior. It's never really because of demand or supply. So even though there is a very, very high demand for gold right now, as I just showed you, the prices have actually been falling. So in that sense, demand and supply doesn't really apply to gold. So this makes gold very unpredictable. It's a very unpredictable commodity to buy, and you never really know what's going to happen. It does seem to kind of increase in value when world goes upside down and people start panicking and throwing away their other money. But unfortunately, you can't really predict instability in the world. So for that reason, I think gold is, once again, a very unpredictable purchase. So even though on this graph you may see that overall gold kind of increased in price, I personally think it's still not really worth the purchase compared to some other investments, and specifically I'll mention one at the end of this video. But if you look at this, let's actually maybe even do a little bit of math. Oh yeah, and by the way, this is inflation adjusted, meaning that inflation has already been taken into consideration here. If you want to see the non-inflation graph, this is what it would look like. So obviously, if you bought like $19 of gold in 1915, 100 years later, this would actually cost approximately $1,100. So basically, it'll be about 60 times higher than it was back in the days, but that's because of the inflation. If you use an inflation adjustment, then you can see that about $450 worth of gold are only worth about $1,100 today. So really it only increased by about 2.5-ish times. But using these numbers, we can actually try to estimate the percentage of average growth of gold when it comes to investments, when it's already inflation adjusted. So let's actually try to calculate this. I'm going to use my calculator here. And so what we're going to use is we're going to use a TI-84 Silver Edition simulator just to see how much we can get from this investment. Let's just say in the year 1915, your grandfather decided to buy, how much is it? 454, let's just say $455 of gold. So we're going to enter 455 right here. We're going to wait for 100 years. And then now today you're going to sell it for 1126. I think it was 1126. So final value, this actually has to be negative 1126. Now what we're looking for is, of course, the interest rate. So what we'll do is we're going to press the solve button and find out that the interest rate is only 0.9%. So it's actually under 1% of growth per year. That's actually very, very little. It's just a little bit over inflation. So inflation would be about 3.5%. This means that the growth here is about 4.4%. Now let's compare this to one of the ETF funds, which is usually what I prefer to invest into. So ETF is an index fund, which is essentially a collection of all of the stocks from a certain market. Specifically this one here, this is the most famous one called S&P 500. This is a collection of 500 biggest companies in the US. And it's the one that's usually used to compare things. And we're going to max this just to show you what it looks like from the basically when it was born, from 1975. So this is when it was $85.62. Now this is not inflation adjusted, so we're going to use that as a value for now, 85.62. So right here for primary value, we're going to enter 85.62. And I'm not even sure if this is correct. It might be actually even lower than that, but it's okay. And then today it's worth, because we have a Chinese recession right now, and it's the September of 2015, we are at 1922. We're going to use the lowest possible value, 1922. And this is 40 years. So from 1975 to 2015, unfortunately, we don't have anything before that. So right here, we're going to enter 40 years and let's find the interest. So remember, 3.5% is the inflation, which we have to add to this, whatever we get here. And what we got is 8.1% approximately, minus 3.5. So that's approximately, I would say, about 4.6% of additional gain on top of that. So it's already about 4% higher than gold. And you might not think that it's a lot, but let's just say that we're going to go back to our original scenario where we actually invest for 100 years and our original investment is going to stay the same. Or let's just actually compare it to whatever the gold was. So what was the gold thing again? Okay, so it was $459 and it became approximately $11.26. So let's just enter this. We're going to enter $459. So now instead of gold in 1915, our grandfather is going to buy index funds, basically a collection of stocks from a certain market. And so let's find out what is going to be our final value if our interest is basically what we just found, and also if we're looking for a final value here. And the answer is $1,095,867. Now, that is ridiculously high in comparison to what this is. No, actually, hold on, I made a mistake. I didn't adjust this for inflation, so let's be fair with this. So let's actually adjust this for inflation, change this to 4.6%, and try this again. Okay, now it should be more accurate. Still, $41,000. It is approximately 40 times higher than what a gold would be today. In other words, gold is not a very good investment when it comes to growth, and obviously gold is not a very good investment when it comes to stability either, because look at that graph. That does not look very stable to me. Gold is unpredictable. It's definitely, it varies on panic, it varies on things going on in the world. And just like stocks, it goes up and down. And I would even say that this goes down a lot more than stocks. So this is an example of what gold looks like. And now compare this to a graph that shows you stocks. So this value right here is probably the lowest you'll have with stocks. With gold though, there's quite a lot of low values going on, and look at that, look how low it was in the 70s. So yeah, I personally think gold is not a really safe investment. I think there's definitely a lot more benefit to invest into bonds if you want safety, and index funds if you want growth. And if you really want to buy gold, there's another thing you can do. And what I'm talking about, of course, is buying ETFs that represent gold. Well, I think this is actually one of the biggest ones, and this is probably one of the most traded ETFs as well. It's basically GLD, and it's called SPDR Gold Trust. It's an ETF, basically a collection of different stocks and different futures and so on and so forth that represent gold market. It also includes some mining companies in it, I believe, and there's a lot of gold-related stuff that you can basically buy if you buy this particular index. And if you look at, since its creation, which was, I believe, in 2004, it actually has already increased by 142%, and that's quite a lot. It means that, from the value of about $40, it went up to about $104. So it's more than doubled already. And obviously, it's been going down for the past few years, but this will probably rebound at some point when the world decides to panic again. And if you do want to go the ETF way, there's another really famous one that's actually probably the first ETF that was created when it came to gold. And it's the one that's probably the most stable as well. And this particular ETF is called Central Fund of Canada Limited. So this is CEF. It's been around for several decades, and it's probably the most stable and the most well known as well. This one here started, well, okay, in US it started like in the 80s, but has increased quite a lot as well. So it's actually maybe it didn't increase as much because of, in here in this particular region it wasn't doing so well, because in the 80s and 90s people in the late 80s and 90s, people weren't really, buying gold, but in the last 10 or so years, it did pretty good. So this is probably the most well-known gold fund. But obviously, this is not the same as investing into actual gold. So this is not like buying actual gold bullions or trying to invest into a bank that holds gold. This is more of a kind of a diverse investment into various gold-related equities. So once again, you're basically playing on the stock market, not as opposed to buying actual gold. And I personally think this is probably the best way. If you really want to get into gold, this is probably one of the better ways. So either CEF or GLD are your tickers for this particular investment. And we finally come to my conclusion. My conclusion is that I think gold is a great tool, but only for countries. It's a great tool for countries that try to battle inflation, that try to stabilize the currency, like Russia and China right now. And I personally think that it is a bad investment. It's a really bad investment for individuals like you and me. If you want to grow and if you want to be stable, it's much better to just buy index funds, and this is for growth, and the various bonds for stability. So having a portfolio full of different index funds and bonds will probably be enough for you to diversify and to become a very successful investor. So I would really avoid gold unless you want to get into gold ETFs, which are a pretty good investment as well. Other than that, I think that's it for me. Thank you for watching. Enjoy your day and don't buy gold. Bye-bye.